This video comes with a warning. It is not my regular market update that I produce on most Mondays. It is what I'm calling a Geek update. I'm trying something a little bit different. If you are not a Hurst Cycles geek, in other words, if you are not obsessed with the details of performing a Hurst Cycles analysis, then I would encourage you not to watch this video, but to go and take a look at one of my regular market updates. If, however, you are a geek, then I hope that you enjoy this new format. Before we do that, I must ask you to please make sure that you have read and understood these disclaimers. So in this update, I'm not going to be repeating everything that I have spoken about in a previous market update. The idea behind these updates is we drill down into the details. I receive many emails and comments every week after my market update video, asking for clarification about things and asking for updates as each hour or each day passes. And that's really what we're going to be focusing on in today's update. If you haven't seen Monday's update, I would encourage you to go back and take a look at that first, otherwise you might not really know what I'm speaking about. So here is the S&P 500. I'm working with data up until before the market opens on the 20th of January. And as you can see, price has formed a peak and it has started moving down. So let's just update ourselves with the 80-day FLD, which I was speaking about in Monday's update. There is that 80-day FLD on the daily chart. Now, I didn't actually show the 80-day FLD on the daily chart because an 80-day FLD is better observed or watched on a weekly chart, and so that's why I showed it in the weekly chart in Monday's video. So you will notice that the 80-day FLD was in fact crossed to the upside by daily price bars at the end of last week. That was on Thursday. It crossed above the 80-day FLD. And on Monday, when I recorded the market update, price was above the 80-day FLD. But you will notice an interesting thing with the FLD, and this is something to look out for, because the FLD is simply the median price displaced to the right. It can have situations such as this where the FLD drops down on a daily basis and then jumps back up again. And so even on Monday, we knew that if price didn't move up strongly, it would have pretty much ended up below the FLD on the next day. So you need to watch out for those FLD spikes. Let's quickly take a look at this on a weekly chart. So we'll change that to weekly. And you can see what happened was exactly what we were expecting and what I was speaking about in Monday's video, which is the fact that price, having crossed below the FLD over here in what I was calling an F category interaction, came up and found resistance at the level of the 80-day FLD. And so market action is turning out pretty much exactly as we expected. This is, of course, my preferred analysis that I'm looking at, which has a 20-week cycle trough over here in the middle of October. And this analysis expects an 18-month cycle trough to occur over here towards the end of February, perhaps even early March. But let's focus in on some of the detail for this update and discuss what is happening now. Let me turn that FLD off. What I like to do now with the new feature in Sentient Trader is to simplify things. I'm fairly used to looking at these charts with many circles and whiskers and diamonds and unnecessary diamonds. But what I'm going to do is hide some of these diamonds. And I'm going to hide the longer cycle diamonds. The reason I'm doing that is because, as you know, we are watching two different analyses. So if I hide all the diamonds and circles and whiskers from the 18-month cycle upwards, then we are only seeing a potential 40-week cycle trough over here at the end of February. I'm actually going to hide that 40-week cycle trough as well. The reason I do that is because it enables me to focus on one chart and yet at the back of my mind consider both possible analyses. I hope that makes sense. You see here we have a 20-week cycle trough, and here is the nest of lows for the next 20-week cycle trough. What about the 40-week cycle and the 18-month cycle and all those longer cycles? I'm not worrying about those for now. All I'm focusing on is cycles up to the 20-week cycle, which of course therefore includes both of the analysis possibilities that we are considering. The one is that the 18-month cycle trough is going to occur over here at the end of February, and the other one is that the 18-month cycle trough might have occurred over here in the middle of October. So let's take a look at what has been happening here. We have an 80-day cycle over here, which is, of course, a bullish 80-day cycle. What are we expecting next? Well, because this is the second 80-day cycle in the current 20-week cycle, we would be expecting a less bullish cycle to play out. Now, as I've mentioned, I'm ignoring the longer cycles for the moment. But as you know, if this is going to be the 18-month cycle trough over here at the end of February, then this will not only be a less bullish cycle, but it will probably turn into a fairly bearish, possibly a nastily bearish 80-day cycle that is playing out over here. If, however, the 18-month cycle trough occurred in the middle of October, then it might not turn into a bearish 80-day cycle, but it will certainly be a less bullish 80-day cycle than that which elapsed from the middle of October to the middle of December. So let's zoom in and consider what is happening now. And I'm going to display the 20-day FLD, which, as you know, is a very reliable FLD. Sometimes people think that the FLD trading strategy only works with the 20-day FLD. That is certainly not true, but the 20-day FLD turns out to be a very reliable one. And when I started trading using the FLD trading strategy, it was the FLD that I traded with, because at that time I was trading over a time frame that was appropriate for the 20-day FLD. So here is our sequence of interactions following the 80-day trough over here in the week before Christmas. Our first interaction should have been an A category interaction, where we would expect price to cross up above the FLD and achieve the target generated as a result. It failed to do that. Is that a serious warning sign? In my opinion, it isn't, because we have to bear in mind what was happening at that time in the markets. And of course, this was the week between Christmas and New Year, and so the markets were very quiet. And in the first few days of January, the markets continued to be fairly quiet. As you can see, trading was pretty much trapped within a range. And so I'm not particularly worried about the fact that the A category interaction turned out to be a disappointing one or a failed one, because price didn't really cross cleanly above it. But that's not a problem at the moment. The next series of interactions, or at least the next interactions that occur, are the B and C category interaction. Now, you will have noticed that recently in these videos and in all the things that I speak about when it comes to the FLD trading strategy, I tend to couple the B and C category interactions and the G and H category interactions, because they are, of course, a pair. They always have been a pair. The B category interaction is where price comes down to the 20-day FLD and finds support at that FLD, and the C category interaction is where price moves away from that FLD. And so the B and C category interactions occurred over here in the first week of January, where price came down. You can see it opened fairly high. That's the open price on the 2nd of January. It opened fairly high, came down to the 20-day FLD, spent 3 or perhaps 4 days of that week straddling the 20-day FLD, which is a good example of price finding approximate support at the level of the FLD, and then, of course, price broke away from the level of the FLD and came up and far exceeded the target that could be generated from this low point over here to a rather complex crossing level, which was somewhere over there, which generated a target over here. Price exceeded that target, as you can see, to reach up to this peak, which occurred on Tuesday, I think. I've drawn over it so we can't really see it. So what is going to happen next? Well, we next expect a D category interaction as price drops down below the 20-day FLD into this 40-day cycle trough. Here is the nest of lows for the 40-day cycle trough. So let's speak about that and what is expected to happen now. First of all, when are we expecting this 40-day cycle trough? You can see I have counted the number of bars from the 80-day cycle trough, and that is now currently today at 29 days. The average length discovered by Hurst 50 years ago for the 40-day cycle is in fact 34.1 days, and so we still have 5 days to go. But we are certainly within range of the time that 40-day cycle trough can be expected, as shown visually by this nest of lows. So a nest of lows is really simply a visual representation of the period of time in which a particular trough is expected. It's a very clever device that Hurst came up with in terms of very quickly and visually observing when the trough is expected. Let's, because this is a geek update, get a little bit geeky about the nest of lows and discuss what is happening with this nest of lows. The 20-day and the 10-day circles are a little bit on the left, whereas the 40-day circle is on the right. The reason for that is because of possibly shorter wavelengths, but more importantly, in this situation, the 20-day cycle trough has been found over here on the 3rd of January. I would actually probably, if I was doing this manually, shift that 20-day cycle trough right to the 6th of January, I think, to that Friday bar, because in my experience it would be better placed over there. And if we count the number of bars, you can see, I think, that might have been a better position for the 20-day cycle. Yes, indeed, 15 days would be a much better position for that 20-day cycle. I don't sweat the details too much because this analysis is looking good, and at this time frame, this is really all the information that I need. And so considering that the 20-day cycle trough might be better moved a few days to the right, how many days would that be? 3 days to the right. Then, of course, the circle for the 20-day cycle and for the 10-day cycle could also be considered to be better placed 3 days to the right, which would bring this into a better alignment. As a matter of interest, and again, because this is a geek update, why has Sentient Trader positioned the 20-day cycle trough over there on the 3rd of January instead of the 6th of January? The reason has to do with the way in which the analysis is performed and solving the analysis puzzle all the way down to the 5-day cycle, which is, of course, the shortest cycle that we have in an end-of-day analysis. And in simple terms, you can see that we have the 10-day cycle very obviously positioned at that low point over there. That was the 28th of December. And so Sentient Trader prefers that more balanced M shape than the potential M shape that would be caused if it shifted that trough a little bit later. That's a simplification of that process. But answer to the question as to why the 20-day cycle trough is over there as opposed to over there has to do with the breakdown of the shorter cycles using the information it has, which of course on an end-of-day basis is not very detailed. So we are now expecting a D category interaction with the 20-day FLD as price crosses down below the 20-day FLD on its way down to the 40-day cycle trough. We are expecting the 40-day cycle trough fairly soon, as is indicated by that nest of lows. As I've mentioned, there have been 29 days since the most recent 40-day cycle trough, which was also synchronous with the 80-day cycle trough. And the average length is 34 days. Let me write that 34 again because it's an important number to bear in mind. The other number to consider when expecting a trough to form is the recent average wavelength, which you can see at the bottom right of the chart over here, which has been 31 days. So we have three figures here. We have 31 days, 34 days, and 29 days. The 31 and the 34 indicate that we could expect the price trough to occur, the 40-day cycle price trough to occur over here on about the 22nd of January, or if it turns out to be a perfectly average cycle, it might occur on the 25th of January. There have been 29 days that have elapsed up to this point over here, and you can see that the nest of lows, which indicates the combined expectation of all the shorter cycles, is indicating that that trough is certainly due now. So what is going to happen as price comes down to the 20-day FLD? According to our expectation of a D category interaction, we would expect price to cross below the FLD and to generate a target, which we can measure by measuring from the peak that occurred on Tuesday down to this level and projecting an equal distance downwards, and that would be our target for the 40-day cycle trough. Are we expecting price to hit that target? That is an excellent question. Now we come back to our consideration of the two possible analyses. If my preferred analysis, which remember would lead us to expect a bearish 80-day cycle at this point, if that analysis is the correct one, then we would expect a bearish target to be achieved. If, however, the other analysis is the correct one and the 18-month cycle trough occurred in the middle of October, then any bearish target would not be expected to be achieved. And so, again, we have something that we can watch very closely to monitor the state of the market and to inform our decision process involving those two analyses. An interesting point to be made here is that the 40-day cycle trough is nearly upon us according to the nest of lows, which of course is constructed using the shorter cycles. And so it is quite possible that that 40-day cycle trough is already going to occur. When price touches an FLD or crosses the FLD late in the cycle progress, and we're looking here at the progress of the 40-day cycle, when it touches the FLD late in the progress of that cycle, we need to be alert to the fact that the FLD might in fact provide support and not generate a good clean cross with price moving all the way down. On the other hand, it only took 2 days for price to reach that FLD, and if this move continues, it might take only another 2 days for it to reach the target, which would mean that the 40-day cycle trough would then occur pretty much on time, and we wouldn't be stretching that 40-day cycle too much. But we need to be alert at this point for the potential formation of the 40-day cycle trough. Now let's quickly, because this is a geek video, let's quickly take a look at the way in which price has already interacted with this 20-day FLD. And this is getting really geeky. If you're still with me, then you are obviously a Hurst Cycles geek. Welcome to the club. So when price comes down to an FLD, you will often observe this kind of thing where price will touch the FLD, then bounce down below it, and then come up again and close above the FLD. Has price crossed this FLD? I would say that it hasn't yet, or should I say yesterday, it hadn't crossed that FLD. Today, of course, if today's trading was complete, then we would say it has crossed the FLD, but today's trading hasn't even really started. The regular trading hours in the US haven't even opened, and so price has not yet crossed below it. But the way in which you check to see whether an FLD has officially been crossed is you take a look at the median line, and there is the median line, because we need the median line to cross below the FLD to confirm that that FLD has in fact been crossed. And as you can see, it's rather rough, of course, because I've zoomed in so much, but you can see there quite clearly that the level of the median price over there is not below the level of the FLD price yesterday, and so this FLD has not yet been crossed. It is quite possible that price is going to bounce up again, and we are going to get a period of time in which price is straddling this 20-day FLD, and then when we look back with the benefit of hindsight, it will not have crossed that FLD, and it will have instead found support at the level of the FLD. I mention that because I think it's quite important to focus on these details, particularly if you're trading this market. It has not yet crossed the FLD. Of course, that is not my expectation. I am expecting it to cross down because of the fact that I am expecting this to be a bearish cycle, but you have to be very careful of allowing your expectations to blind you to what is actually happening in the market. A very sensible comment on Monday's video suggested that I provide a conclusion to these videos. It's a very good idea. So in conclusion, price is of course at the level of the 20-day FLD. I am watching with great interest to see whether it does cross below that FLD, in which case I would be then watching the target that would be generated as a result. We cannot yet work out that target because we do not have a completed bar bar for today's trading, and only when we have a completed bar can we correctly work out that target. And when we have the target, it's going to be interesting to see whether price does reach down towards that target or does not. If it does, then we will still be in line to watch a deeper trough, an 18-month cycle trough forming towards the end of February or early March. If, however, price now finds support and starts bouncing up again, then my preference is probably going to switch to the other analysis. Either way, we are expecting a trough towards the end of February or early March. It will be a trough of at least 20-week magnitude. And no matter which analysis is correct, we are, of course, expecting an M shape to elapse over here. I have drawn a very neutral M shape, but that M shape will probably not be neutral. It will be either bullish or bearish, depending on which of our analyses is correct. I do hope that you enjoyed this first ever Geek update. If you enjoyed the Geek update, please let me know and I will record more of them.